So, before the break I was explaining that if we exclude the higher order terms, that if we exclude convexity and other higher order terms in the Taylor series, what we find is that the duration gives us the linear approximation of the yield price curve at the point at which the duration is calculated. I emphasize that the straight line assumption or the straight line nature of duration holds only for very small shifts around the given point, infinitesimal shifts around the given point y 0. Now, in this slide what I have tried to show is that it is the second order derivative and not the first order derivative which captures the curvature, in the curve, yield price curve, and in any curve for that matter. The curvature is captured by higher order terms in the Taylor series. The first order term is the linear term. Now, what is the inference of the curvature? What is the impact of curvature on estimation? That is very interesting. Higher the curvature or convexity, the general term is curvature, but as our curve happens to be convex towards the origin, the curvature is convex towards the origin, we also call it convexity. So, higher the curvature or convexity of a bond, greater will be the deviation of the actual price shift due to a shift in interest rates from the shift calculated using the duration formula. In other words, if you ignore convexity and you calculate the price change dp upon p, percentage price change, the result that you will get will deviate more and more from the actual price change, will be different from the actual price change depending on how much is the curvature of the bond. If the curvature is higher, if the convexity is higher, then what happens is that the estimate that we arrive at using the duration, using the linear approximation turns out to be off the mark by a greater margin. If the convexity of the bond is lower, obviously then the curve is closer to the straight line approximation embedded in the duration, and as a result of which the price change that we estimate using the duration for a bond with smaller convexity may be close to its actual value. In other words, greater the convexity, higher will be the error by using the only duration formula compared to the complete formula using both duration and convexity. Let us do an example. Consider a 12% coupon bond with a yield to maturity of 18%. The coupon rate is 12% and the YTM is 18%. The life is 5 years. It has 5 years remaining to maturity. What is the bond's current price assuming annual coupons? What is the bond's duration and convexity? What percentage change might you expect if the yield to maturity suddenly increased to 25% from 18%, change of 7% plus 7%. Calculate using duration alone and then using both duration and convexity and compare it with the projected price change using the cash flow formula. So, it is a comprehensive example. The solution is here. When you discount all the future coupon payments and the face value at maturity, as you can see here, this is the YTM, and so that constitutes a discount rate. These are the DCF values or discount factor values at 18%. The second line, this is the discount factor values at 18%. This is the coupon payment. This is the coupon payment, and this is the coupon payment plus the redemption of principal at maturity. When you compute the discounted future cash flows from the bond using these discount values, what you arrive at is 81.23. This is the current market price of the bond that corresponds to the YTM of 18%. Then we work out the duration. To work out the duration, we need to find TCT, the product of the time at which the cash flows takes place together with the magnitude of these cash flows, which is given in this row, and then we discount each of these cash flows or TCTs rather, time weighted cash flows or cash flow weighted time, at the discount rate of 18%, which is the YTM, and we arrive at this expression. Dividing this expression by the price, we get this expression for the duration 3.925 years. Similarly, we work out the convexity and we find that the convexity is 10.78 years squared. Now, what is the actual price change? To work out the actual price change, we use the new YTM and we again work out the DCF at the new YTM of 25%, and what we get is the actual price is 65.039. So, original price was 81.223, the new price is 65.03. So, the actual change is 19.94%. 19.94%. If we use only duration and calculate the change in price, it turns out to be 23.28%, and if we introduce the convexity correction, we end up with 19.48%, which is pretty much close to our actual price change of 19.94%. Please note here the YTM is changing by as large as 7%, and notwithstanding that, if we use both duration and convexity, we are arriving at a pretty close estimate of the percentage price change. So, this is how this example can be done, and I recommend that all the learners work it out for themselves also. This is the summary of how the calculations have been made. This is the duration figure, this is the convexity figure, and how do we work out the price change? dP upon P, this is the percentage price change, is equal to minus dmac into dy rather upon 1 plus y0. Y0 here is 18%, dy is 7%, so that is 0.07. When you plug in these values, what we get is 23.28, which is the figure that we have here. Okay, so let us continue. Then we talk about modified duration. We will be coming back to duration, but in a different context. Let us talk about modified duration. Modified duration is a modified version of Macaulay's duration. We define modified duration in relation to Macaulay's duration by this expression. So, d modified is equal to dmac divided by 1 plus y0, where y0 is the YTM at which the Macaulay's duration is calculated. And when you use this expression for the modified duration, what we find is that the percentage change in price is given by this rather simple expression. The percentage change in price is given by this rather simple expression. Why? Because the factor of 1 plus y0 is absorbed into the definition of duration in the case of modified duration, and we end up with this simple expression for demodified. Therefore, in fact, this expression, this formula, let us call it 1, can be used to provide a definition for modified duration, as it is the percentage change in price corresponding to a unit change in the YTM. So, that is the definition. The modified duration of a bond at a given YTM is the negative of the percentage change in price of the bond for a 1% change in YTM. Since price and YTM are inversely related, modified duration returns a positive figure. Please note, as in the case of duration, we also add a minus sign when we talk about modified duration, so that the figure that we get as the output is positive. It is more convenient to deal with positive figures, and that is the reason that we introduce a negative sign whenever we talk about duration or modified duration. Here, as you can see here, we have a minus sign here, and you can see here also when we talk about Macaulay's duration, you also have a minus sign here. Duration of semi-annual bonds. The duration of a semi-annual pay bond can be calculated in the same way as a weighted average of the number of semi-annual periods until the cash flows are to be received for each cash flow, instead of using, you see, it's quite straightforward. Instead of using 1 year as the measure of time, we use 6 months or half year as the measure of time, because the cash flows are occurring at intervals of half year. So at the end of each half year, we use that cash flow, and we use the semi-annual period as a measure of time, and we calculated the cash flow cash flow weighted time that will be worked out in terms of the semi-annual period, and using that semi-annual period, we can work out the annual duration of a bond. So the duration of a semi-annual pay bond can be calculated in the same way as a weighted average of the number of semi-annual periods until the cash flows are to be received. In this case, the result is the number of semi-annual periods rather than years. For a semi-annual pay bond with a YTM quoted on a semi-annual bond basis, we work out the duration as per this formula, a modified duration as per this formula. The modified duration can be annualized from semi-annual periods to annual periods by dividing by 2, and then used as the approximate percentage change in price for a 1% change in the bonds YTM. Now we talk about interest rate elasticity. Interest rate elasticity is given by the percentage change in the price of a bond divided by the percentage change in the YTM as a percent of the original YTM. The change in the YTM as percentage of the original YTM. Please note this. The numerator is the percentage change in price. There is no issue about this. There is no confusion about this. But as far as the denominator is concerned, it is the change in YTM expressed as a percentage of the original YTM, and this is what we call the interest rate elasticity. In terms of duration, it turns out to be this expression minus dmax upon 1 plus y0 into y0, or minus d modified into y0, where y0 is the point or is the YTM at which we are working out the interest rate elasticity. And importantly, we are ignoring the convexity of the yield price relationship. So a quick recap here. We started with dV01, which is the change in, not the percentage change in price, which is the absolute change in price corresponding to a given change in YTM, or a 1% change in YTM, or a unit change in YTM, with a negative sign, of course, to return a positive figure, because YTM and price are inversely related. Then we talked about the duration and convexity of the bond, which is captured by this expression. I also introduced modified duration, in terms of which dP upon P can be written as this expression, and then we talked about interest rate elasticity, which is given by this expression. There is another problem. Consider a 10% annual coupon bond with a maturity of 2 years. The bond is quoting at a YTM of 18%. Coupons will be paid at the end of the first and the second year. Redemption at a discount of 25% of face value will be made at the end of the second year. Calculate the bond's Macaulay duration and convexity. This is a rather simple problem, much simpler to what we did earlier, and this is the solution to this problem. We end up with a duration of 1.8781 years using the formula for duration. This is the formula for duration that we have discussed earlier as well, and this is the convexity. The convexity turns out to be 2.7562 years. This is the Excel working of the formula of the question. On the basis of the value of duration and convexity arrived at in the previous question, calculate the price change in percentage corresponding to a 5%, this is delta y, increase in the YTM from the above figure. So the original YTM was how much? The original YTM was 18%. The original YTM was 18%. the YTM is increased to 23%, and this is the change in the price of the bond using duration alone. This is the convexity correction, and this gives you the change in price with up to second order correction, that is correction together with the duration and the convexity, and this is the actual change in price 7.49%, and here you have 7.46% as the approximation up to second order. Now we talk about immunization. I had given a feel of what immunization is right at the beginning of the last class when I talked about investment in a bond. Now, I mentioned there that if there is a change in the interest rates, obviously there would be a change in the reinvestment income and the capital gains due to an investment in a bond. Now, the important thing is I also mentioned the second very important facet, and that was that these two forces operate in opposite directions. Nevertheless, notwithstanding the fact that they operate in opposite direction and would annul each other to some extent, the extent of annulment depends on the holding period of the investor. If the holding period is shorter, the impact on reinvestment income is less, the impact on capital gains is much more, and therefore, again the annulment will not be perfect. Conversely, if the holding period is very close to maturity, then what happens? Reinvestment income effect is more, the price effect or the capital gains effect is less, and again there would be a mismatch and the annulment would not be accurate. However, there exists one such point in this line. This is 0, this is T, let us call this H. H is my holding period. There is one special holding period such that if you hold the bond up to this holding period H, then what happens? Then if there is a change in interest rate during the life of the investment, the change in the reinvestment income, a change corresponding to or consequential to the coupon's reinvestment exactly matches the change due to the change in the price, and as a result of which these two effects exactly cancel each other, and because these two effects exactly cancel each other, what happens is the investor becomes immunized against a change in the interest rate. If there is an increase in interest rate, the increase in investment income is exactly neutralized by the decline in price, and if there is a decrease in interest rates, the decrease in reinvestment income again is neutralized by the increase in the price of the bond. So, consider a case when the interest rates increase immediately after a bond investment. Obviously, the income from reinvested coupons increase. Please note this point. Obviously, the income from reinvested coupons will increase due to the increase in interest rates, reinvestment rates. Because the interest rates have increased, so all the coupons would be reinvested at the higher rates. However, the anticipated price at the end of the holding period, please note this is not the maturity value, this is not the maturity value, this is the value at this point when the bond will have to be sold in the market to realize or to end the investment horizon. The anticipated price at the end of the holding period, which is the investment horizon, will decrease. Why? Because the rate, the coupons and the final value or maturity value will be discounted at a higher rate. The interest rates have increased. So, and hence the expected capital gains would decline. Thus, the reinvestment income and the capital gains move in opposite directions due to a change in interest rates, and hence annul the effect of each other to some extent. I have dealt with it in a lot of detail. Nevertheless, the extent to which these effects would cancel each other would also depend on the holding period of the investor. The longer the holding period, the greater would be the effect on reinvested income of an interest rate change, and smaller would be the effect on the price, since the bond would be closer to maturity and hence fewer coupons would be available for discounting, as well as the terminal cash flow would also be very close to the holding period, and therefore the discounting periods would be at the period of discounting of the terminal cash flow will also be lower. In fact, there exists a holding period at which, this is the important part, holding period at which both these effects exactly annul each other. This holding period turns out to be the Macaulay's duration. So, Macaulay's duration, in addition to being a measure of interest rate risk, is also has a very important property that if the holder, if the investor holds the bond up to its Macaulay's duration, if the investment horizon coincides with the Macaulay's duration and there is a small shift in interest rates during his holding period, his return does not change, because the reinvested income and the capital gains that move in opposite directions annul each other for that particular holding period. We will take it up with an example also later on. So, let us see how we arrive at this expression that Macaulay's duration constitutes that holding period for which the return is independent of small changes in the yield shift. This is the formula for the price of a bond, or formula for the YTM of the bond. You may look at it either way. Price and YTM, they are closely related quantities. Let H be the holding period of the investor, then the total cash flows for the investor at T equal to H will consist of two parts. It will consist of proceeds of reinvested income plus sale proceeds. The proceeds of reinvested income can be written in this form, and this is the price at which the bond will be liquidated in the market at the end of the holding period. Now, what is pH? pH is obtained by discounting all future cash flows from T equal to H onwards. All future cash flows arising from the bond from T equal to H onwards up to its maturity and discounted back to T equal to H. I repeat, how do we get pH? We get pH by discounting all future cash flows from the bond from T equal to H onwards at the appropriate market rates up to, or bring them back to T equal to H. So, the formula turns out to be this expression. We start with j equal to 1, that is, we start with CH plus 1, then CH plus 2, CH plus 3. So, we write it as CH plus j, where j is summed from 1 to T minus H. There will be T minus H coupons, H plus 1, H plus 2, H plus 3 up to T, T minus H coupons, and they would be discounted backwards. The coupon at T equal to H plus 1 will be discounted for one period, the coupon, because you are discounting up to the point T equal to H. So, the coupon at T equal to H plus 2 will be discounted for 2 periods, and T equal to H plus 3 will be discounted for 3 periods, and T equal to capital T would be discounted for T minus H periods. The objective is to bring everything back to T equal to H, not T equal to 0. Because we are working out the price pH, we are working out the price at T equal to H. By a revision of the indices, we can write this expression in this form by a renaming of the index, from substituting the index from j equal to j to t, where t takes the values from h plus 1 to capital T, where capital T is the maturity, h is the holding period. Let me remind you, and in terms of the index t, I can write this expression in the form of this expression, and which can be further written as this expression. Very simple. We simply take this to the numerator. We take this denominator to the numerator and we arrive at this expression. Okay. So, the total when we substitute the values of pH given by this equation, let us call it A. In this equation, let us call it B. Substituting from A in B, substituting the value of pH from A in B, what do we get? We get this expression, which can be combined together and we get this result. So, this is the result that we have, this is the total cash flows that will arise at t equal to h, which is the end of our investment horizon when we liquidate the bond at this point. So, what we do now is, please note this expression, the total cash flows is a function of obviously the interest rate, that is y, the YTM of the bond, and the holding period. As I mentioned, holding period is everything to do with the cash flows that we are going to realize at the end of that holding period. So, we take the first derivative with respect to y. By taking the first derivative, what we get? We get this expression. Our next objective is to equate this first derivative to 0. Why are we doing this? We are doing this because we are looking for that holding period, we are looking for that value of h, such that if I hold the bond for that value, for that holding period, for that investment horizon, then the change in the total cash flows consequent to a small change in y, that is dy, turns out to be 0. That, in other words, the slope of the curve at this point turns out to be very flat, is almost 0. So, that if there is a small change in YTM either to the left or to the right, that does not impact our total cash flows to any significant extent. So, when we do that, when we equate this to 0, when we equate this expression to 0, and we simplify a little bit, what we get is h of y, h as a function of y is given by this expression. And believe it or not, when you see this expression very carefully, you find that it is nothing but d max. It is nothing but the formula that we have arrived at for d max. So, what is the outcome of all this stuff? The outcome of all this stuff is that if you hold the bond for a period, if your investment horizon for holding the bond coincides with the bond's Macaulay duration, then if there are small shifts in the interest rate, the small shifts in the interest rate will not affect your overall return. Thus, given any rate y, if an investor adopts a holding period h y given by this expression, which is equal to the duration, MAC duration, you end up with the total cash flows from the investment are immunized against changes in interest rates. The caveat, this formula looks very attractive, very exciting, and very innovative, but there is always a catch to such a formula. The catch is that the immunization of the cash flows extends over infinitesimally small range y minus dy to y plus dy of interest rate y. If there is a significant or a massive change in interest rates, this formula breaks down. It only holds if the change in y is of infinitesimal nature, is of very small nature, either to the left or to the right, whatsoever the case may be, but the magnitude of the change has to be very small. If the magnitude of the change is small, then what happens? What happens is that the investor gets immunized against any change in return, any change in the total cash flows at the end of his holding period. Obviously, his investment is fixed. So, the return that he gets over his holding period is also unchanged due to notwithstanding that there is a minor change in interest rates to the left or to the right. This is because Newtonian differentiation presupposes a straight line structure in the infinitesimal neighborhood. This line is, or this is a very important infinitesimal neighborhood. Whenever you work out a derivative under the Newtonian concept, you assume that around that point at which the derivative is being calculated, the curve can be approximated well enough by a straight line. So, that is precisely what we are doing here. Please note, we have worked out the Newtonian derivative here. This is the Newtonian derivative, and when we talk about the Newtonian derivative, we assume that the relationship between TCF and y at that point is almost a straight line. Because the price yield curve is non-linear, the immunization will not extend over a large variation in y. So, the immunization or the protection that we have consequent to this derivation, consequent to our holding the bond up to its duration will not hold if there is a significant change in the YTM, then the immunization breaks down. Furthermore, it is also assumed that the value dy is the same for all maturities, that is, the shift of the yield curve is parallel to itself. This is another very important assumption, but I will defer it for detailed discussion to a later class when I talk about portfolio fixed income portfolio management. What we are basically saying is that the yield curve is shifting parallel to itself. The yield curve is shifting parallel to itself, that is the rates, the interest rates corresponding to different maturities are changing by the same amount dy. Then there is an example which I shall take up in the next class. Thank you.